following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everyone, welcome back to the Advisor's Option, the program designed for busy financial advisors who are looking to find ways to implement options into their portfolios, as well as for a lot of you listeners out there who may be looking for a financial advisor and want to learn what your advisor really should be up to and which ways he should be implementing options in your portfolios. My name is Mark Longo from the OptionsInsider.com, as well as from the Options Insider Radio Network. And I am joined today for this final episode of 2013 by two of my usual companions here on the old Advisor's Option. Starting off, let's go in order of distance. I think Randy may have you beat, Eric. So we'll start off with Randy Swan. Of course, he is the co-founder of Swan Wealth Advisors, situated out there in scenic and lovely Durango, Colorado. Randy, welcome to the program.
Thank you very much. It feels like Christmas out here in Durango. It's actually snowing right now, so I'm looking forward to hitting the slopes tomorrow.
Yeah, we get all the fun of the snow out here in Chicago as well, but without the slopes. Yeah, it's certainly been quite the winter so far. I think we're making up for the past 2 years where we had essentially 70 degree weather in February out here, and the boats were running pretty much all winter long on the river. Now this year the river is iced over already, and it's been snow a bunch of times. So I think we're getting some cosmic payback here over here in Chicago.
I think it's the law of averages.
Yes, that's at the end of the day, it's all mean reverting, right? Even weather.
That's right.
Speaking of cosmic payback, the gods have seen fit to saddle me with none other than Mr. Eric Cott, the Director of Financial Advisor Education over there at the OIC. Eric, welcome back to the program, sir.
Mark, always a pleasure to be with you, be with Randy as well. I wish I was on the slopes. We've been blessed here in Connecticut with a lot of snow, which will, based on, I guess, global warming, will start to melt. We're going to be getting up to in the 60s here on Sunday, right before Christmas. So I think it's going to look more like Palm Beach than it will look like Currier and Ives here in Connecticut on Main Street up here in Fairfield County. But, yes, excited to be here for year-end, and really hard to believe that we're wrapping up another year in the markets.
So no time to hit the slopes at scenic and lovely Powder Ridge, huh?
No, I don't know if I'm going to get the Thunder Ridge or Powder Ridge, or maybe there is a new mountain that's reopened here, which maybe we'll get some man-made snow. But we'll hope to do that in between Christmas and New Year's.
All right. And with the team assembled, it's time to dive into our final Options 101 segment for 2013.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everyone. Welcome to Options 101. Recording this here at the end of 2013. Has been a tumultuous year. Certainly has been an interesting one from the perspective of the advisor's option and all the different options education we've done this past year. And we thought, what better way to wrap up the year than really to take a look back at all of the interesting and relevant strategies that we really outlined for you guys over this past year and kind of hit on some of the most salient ones for you guys, whether you're a new listener just tuning in for the first time or you're a listener who kind of wants a bit of a refresher. The one thing I've learned from interacting with advisors, particularly from an options perspective, is that they'll never turn away from a refresher about options and what they do. They always want more education, more information, more ways to implement these types of products in their portfolio. So we're going to do exactly that today with a bit of a look back on all of the different topics that we hit on this year. And we had a couple of different themes, if you look at our show, a couple of different narratives for the educational paths that we took this year. And we're going to start it off with a path we took, a little bit of a track we took later in the year, which I think is really interesting for the vast majority of our listeners. Because when you break down the audience for this show, most of the advisors out there and asset managers are in the equity camp. They are long equity in their client portfolios. That could be individual equities. That could be a lot of you in things like SPY or maybe even SPX. So a lot of you have broad-based equity portfolios. So a lot of you are coming to options with that mindset and with that need in place. And so we spent a lot of time this year looking at ways that you can use options in conjunction with and sometimes in lieu of the underlying itself. Maybe we'll start off then with looking at a topic we touched on recently, which is a very, very important, particularly today. You know, a lot of the market's been an extended bull market for the better part of the past year. A lot of individual names and a lot of individual indices as well have run up to record high levels. Things are getting kind of pricey out there. And so we're hearing from a lot of our readers and our listeners, and of course listeners of this show, hey, what are some ways that I could use options to try to make my capital outlay a little bit more efficient? And that gets right back to perhaps one of the most useful strategies, and probably one of the simplest as well, that we could really outline here for you on this show. And that is, of course, the simple stock replacement strategy. So an ideal use case for the stock replacement strategy is indeed in a lot of these very pricey underlyings, the Googles, the Pricelines, the Apples, things that are many, many hundreds of dollars, if not over $1,000. And you're saying to yourself, wow, I really don't want to outlay $10,000 or more to buy a round lot of equity in there, and a lot more if you're going to buy more. And of course, the margin situation with equities is pretty much the best you're going to do is 50%. So you have to put up at least half of that money up front to buy all that stock. That's a lot of capital outlay from your portfolio. For most of our listeners, for a lot of our listeners whose clients are allocating portfolios to this or allocating funds to this, you don't want to tie up a significant portion of your clients' portfolios in one individual trade. And that's where the stock replacement really hits home. It's a capital efficiency tool first and foremost. So what we're talking about here, very simple strategy. Typically, you'd see a stock you like, and you go out and you buy 100 shares. In the stock replacement scenario, that's turned on its head a little bit. Remember, we've talked on the show in the past about things like in the money, at the money, out of the money, things like the Greeks, delta, gamma, theta, vega. We're going to focus for this portion of this strategy on in the money calls and on delta being really kind of your primary focus here from the Greeks' perspective. So you're looking at in the money calls, and you want to buy something that's going to approximate the underlying itself. So you want something with a fairly high delta. Delta typically a lot of different not a lot of different nomenclatures for delta, but typically 1 to 100. Could be 0 to 1, 2 in some other weird use cases, but typically 1 to 100. So you want a option whose delta approaches 100 in some fashion. You want something that's going to be very close to approximating the stock itself. Remember, an option with a delta of 100, the underlying moves $1, that option is going to gain or lose $1 in price as well. So we're looking at an option probably in most of these scenarios, stock replacement, you're probably talking 6 months, maybe a year, depending on your time frame of what you're looking to buy. And then you come in, you buy that 6-month call, let's say XYZ, could be, let's say XYZ is trading for 1,000. And so you decide you're going to come in and buy the XYZ 6-month out 850 call. And what that does is a call of $150 in the money. So you have a significantly high delta, probably, let's say in that scenario, 75, maybe even 80. So you have a very good approximation of what the underlying is going to be. Now, remember, all of our early episodes about options, one of the chief benefits of options is indeed the leverage component. So you're coming in and you're not outlying now all of the money to buy the underlying, or you're not even outlying, in this case, 50% of the money to buy the underlying on margin. You're essentially just buying that call option's value. So and that could be 5%, 10%, 20%. It really depends on how far out and how expensive that call is. But if you structure it right, you could get a position that approximates the underlying for a substantial amount of time, 3 months, 6 months, a year, perhaps even longer, for a very, very small fraction of the price you would pay to buy that stock outright. So why would you want to do that? Well, in addition to saving 30, 40, 50, 60, maybe even 70% of the capital that you would outlay initially for that trade, you can now put that money to work on other trades. You've eliminated now the opportunity cost of buying that stock, which in and of itself is a fantastic thing. But remember all the things we've talked about before on this show, about the Greeks, about all the other values that they bring to the table. You're talking about delta now. You have an option that has a high delta, but indeed it has a delta. So it is not the same thing as a stock. Stock always has a delta of 100. It's always going to move 1 to 1. Stock drops $10, you're going to lose $10. If you have an option with a delta now, however, if that stock drops $10, which is the worst case scenario in any long equity position, you're going to lose less money because you have a delta that is less than 1 or less than 100. And also, as the underlying drops, that delta is going to decrease. So you're going to lose money at a slower rate as the underlying drops. That option, remember, you're swapping an option for a stock. So now you're also adding an option with a volatility component. So that means as that underlying drops, again, that worst case scenario, that volatility is going to increase, again, slowing the rate at which you're going to lose money. It's not going to make you money in that scenario, but you're going to lose money at a slower rate than if you bought the stock outright. So there you have it. Simple strategy, stock replacement, a good way to save a lot of capital, use your capital much more efficiently, remove the opportunity cost of buying a lot of very expensive stock, and also put some of the benefits of options to work for you. Leverage, the Greeks, all the great things we talk about on this show. A very simple strategy and a simple thing that a lot of you out there in the advisor community should be doing if you're trading a lot of long equity positions. Now, Eric, you travel the world chatting to advisors, one more time. You travel the world talking to advisors hither and yon about all different types of option strategies that they implement in their client portfolios. When you approach them about something like this, a stock replacement strategy, what's their response? And do you see a lot of advisors really taking advantage of this strategy?
You know, it's interesting, Mark, and I'm glad you brought up that strategy. With the markets at unprecedented gains, we obviously saw what happened with Bernanke this week, and that the Fed's going to reduce their bond buying programs from, $85 billion to $75 billion, and now the markets go up 300 points, and we're all at new highs. And so, I mean, one of the interesting things relative to stock replacement is also for those advisors, maybe as we're getting to year-end planning here, maybe it's in their mindset, they're looking to maybe sell the stock holding and, sort of buying this in the money call option against it. So you're kind of removing the position, but still participating in it. And I think that's where minority of advisors, because, again, traveling around and as we at the OIC deal with all type of channels, I would say that it's not a frequent strategy used by a lot of advisors, but the ones who get it are absolutely discussing it, and finding the value of it. I mean, where it allows you, if you're starting to get nervous maybe about the market, I don't know how you guys feel, but I'm a little nervous going into next year, but we could, we could continually go higher and higher. But it's sort of, I look at that, the replacement strategy is sort of reducing the risk, right? And you still have that potential, as you said, looking out at 6 months. So maybe looking at as a way to also maybe book some of these gains, some of the winners you have, but still maintaining that potential, for that stock. or that holding that you might have.
Randy, what's your take on the whole stock replacement strategy and its efficacy for advisors?
Well, I like the strategy a lot. I would probably like to cover it or combine it with some income generating strategies. So maybe create a bull spread where you're buying the in the money call and selling some out of the money calls to reduce or eliminate some of the time decay. Yeah, absolutely. It's a great strategy as long as it's in proportion to what your portfolio would be doing anyway. Of course, you don't want to take 100% of the portfolio and put it in these types of strategies. It just has to be in proportion to the level of your portfolio in terms of proper diversification.
Yeah, and what you mentioned with the income portion, that really is kicking it up a notch from a strategy perspective. And a lot of our listeners out there, again, you guys love covered calls. It's one of your favorite income generation tools. Doing exactly what Randy just said, combining what we just talked about, this stock replacement strategy, going out and buying the 6-month or maybe even the 1 year in the money call, and now that's essentially the equity portion of your portfolio, and then turning around and writing front month or perhaps even weekly calls against it. It's the same type of covered call trade you've been doing forever, but now you've just kicked it up a notch, to borrow a phrase there from Emerald. You've improved the capital efficiency of it, and you've added all the other benefits we just talked about in terms of the Greeks, the Delta and the Vega coming to work for you in that trade. So this is a fantastic way for advisors to really, very simply, really dramatically improve their clients' portfolios and their returns using options. And you're right, Eric, this isn't a widely utilized strategy among advisors, and it's kind of a shame.
It is a shame, Mark. I mean, I agree with you, and I like the idea when you brought up the example of a fictitious $1,000 traded stock. And I think in the three of us in our minds, I can pinpoint one because I actually I know the CEO of the company. It's a travel company that trades at that share price, and I at times look and I can't imagine that company is trading at the value that it is today. And so I like Randy's idea as well about selling, the front months there and creating that sort of combination, which is really brilliant. And what it's doing is it's setting you apart from the guy down the street, that's offering, just that mutual fund of the week.
If we do nothing else here on this show, we really are hoping to give you, the advisor, tools to do exactly what Eric just said, to really set yourself apart. I mean, you guys know better than us here, even on the show, how difficult it is to set yourself apart in the sea of advisors where everyone essentially is sitting down and putting their clients in long equity portfolios. Maybe they add a little bit of fixed income, and if they're really crazy, they add maybe a dash of gold or something else for real, quote-unquote, true diversification. And that's really about it. So to make yourself stand out in that crowd, you have to do something extra, something special, and that is what we're talking about here. And if you're the one guy on your block or in your town who can do even something as simple as a stock replacement or a covered call strategy, you've now put yourself miles ahead of the rest of the pack, and that is a very, very beneficial thing. So hopefully, listening to this show, you're starting to get that gist from what we're talking about here. Now, we're talking about options. We just talked about options in place of stock. What if we use options really in conjunction with stock? This is a scenario, actually, nice thing right now that a lot of people aren't dealing with. We're having some losses in their portfolio, but it's going to come back again. The market's going to turn around again eventually, and people are going to have those same questions. What do I do when my equity position takes a bit of a dive? And now I've lost 15, 20, 25% in this position. Your clients are calling you up. They're screaming on you. Why did this happen? How can we make this money back? That's a very, very common problem for a lot of advisors. Luckily, options can come to the rescue in that scenario as well. And if you listen to some of our earlier episodes this year, we also talked about the stock repair strategy. This is taking what we were just talking about and kind of taking it up to the next level. In this type of typical stock repair scenario, you have an underlying, let's say XYZ, and now you own it from 100, and the underlying has dropped to, let's say, 80. And now you're looking at it and saying, wow, I'm off a bit here in this underlying. What am I going to do? The clients are calling up. I need to make some of this money back. Should I sell this position and invest in something else? But I'm still kind of bullish on this name. I think it can at least maybe retrace to where it was. But what do you want to do? Do you want to sit there and hang out until the underlying moves all the way back? That could take a substantial amount of time. That could never actually happen. So the stock repair strategy is a great way for a lot of our clients out there and a lot of our listeners to really kick up the returns and kind of get back to break even at a much, much faster pace, which I know a lot of our clients out there really, really will appreciate that. So, Randy, why don't you walk our listeners here through a simple stock repair type scenario?
Well, one of the solutions to that is to start selling call options against the long position. And, obviously you don't want to have the stock drop 20% and then start thinking about writing the calls. I think you would like to write the calls as it's going down, be a little more proactive on the front end and say, as it starts dropping down, to start sell some calls. This will give you an opportunity to make your money back over time, even if the market doesn't, or the stock doesn't recover 100% of its 100% of its losses. I mean, I think you can either do it. You can definitely do it more quickly using the sale of calls against the stock. I think that's the most basic stock repair strategy in this case.
Yeah, you tend to prefer that. I guess you can call it a rolling stock repair strategy. So as you start seeing the underlying moving against you, you write some calls. And I think you like some of the pretty aggressive ones too, maybe even in the money calls, to try to make that back a little bit faster.
Yes. I mean, the other one that's more risky, obviously, would be to, maybe even sell some at the money puts after it's dropped to add to your position. Of course, that's doubling your that's increasing your risk. But if you like the stock and you think the stock is going to recover at some level, that would accelerate how quickly you could get your stock back, or how quickly you could get your losses, make up your losses. It just depends on how aggressive you want to be and obviously how far you want to go out. It's a good strategy. I think it definitely works, but I think you have to be very disciplined and patient to have it to work out.
I think that disciplined approach is really appropriate there, Randy. And again, I know that the advisors have utilized this repair strategy on ETF options as well. So, but I think that it's not that set it and forget it. I think it requires that discipline and oversight to make sure when you're making up these losses.
And as Randy just laid out, stock repair really covers a pretty wide gamut of different strategies. Of course, selling calls at the drops, they're selling the puts, a little bit more risky, a little bit more controversial, I think, for some of you out there to actually be adding to the position. But what the typical, most plain vanilla type stock repair strategy you're probably going to encounter is where you have a position like we just said, XYZ drops from 100 to 80. You're out 20% now on this underlying. And so what do? I want to make that back for my clients. I think it's going to rally a bit, but maybe not make it all the way back. So you're long from 80, or actually you're long from 100, but you own the underlying now. It's trading at 80. You can buy a vertical call spread. So what that would be is, let's say right where you are 80, maybe you say, I think I can make it back to 90. I think it's a relatively reasonable near-term move for this underlying to make. So you buy the 80-90 vertical call spread. So you buy the 80 call, sell the 90 call. And what you do it on, though, you do it on a ratio. So now you buy one call and you sell two. Because remember, you already have an equity position in the stock. So you're already long the stock from 80 or at 80 right now. Then you buy an additional call. So now you're getting long additional units, long additional deltas here in XYZ. So this is, again, dependent on if you think the stock's going to return and rally again. If you think it's going to drop more, there's other things you can do, including selling the stock itself and taking your hit. But if you think it's going to rally again, you buy more deltas, which is buying the 80 call, and then turning around and selling calls on the 90 strike on a ratio, 1/2. So you're buying one call, you're selling two. You might say, wow, that's risky. That's a ratio. I'm going to be naked net short to the upside if it rallies past 90. But you're not. Remember, you actually have the underlying as well. So that will cover the other call that you're selling. If you're buying one call, selling two, the underlying rallies all the way to 90. Now you've made money on the underlying rallying back to 90, and you've made 10 points on that underlying, and then that's called away with the call. So, of course, you can roll them up as well. And, of course, you've added a little bit extra kicker with that vertical call spread of the 80-90 call spread. That's also made money, and that's made another $10, rallying from 80 to 90. And that additional call spread is what's really going to kick up this strategy and get you to break even a lot faster. And, of course, you can do it on all kinds of different ratios depending on how much underlying you have and how much exposure you want to have to this XYZ underlying. But that's the traditional stock repair approach, and that's what's going to get you back to break even at a faster pace with the underlying not having to retrace all the way back to where it started for you to break even, which I know is what drives a lot of clients crazy. Eric, in your travels, do you see stock repair really embraced, perhaps even more than a stock replacement?
Well, Mark, what I always have to throw in there as well, just being from the OCC, is that relative to advisors, utilizing this 1/2 in the call ratio spread with their clients, just taking into account that usually minimal, but they have to be aware, that there are commissions that are typically incorporated into this. They're probably relatively small, but just being aware of that, when they're discussing this with the client.
You're always the party pooper, sir.
Listen, we didn't talk about that on the other side, but I think that's just that's critical. But also though, as you said this, Mark, I mean, I think that what it does is it's that participation aspect, for the advisor that that I always like to hear from them, that they're saying, like, this is that proactive idea that comes into play, rather than just sitting on your hands and hoping, because we all know this with equities or ETFs. You got three outcomes: either goes up, it goes down, or stays the same. But nowhere in that scenario can anybody on this call predict that. But at least you have the control when you're doing an option trade like this.
Exactly. Really what we're doing here at the end of the day, we talked about making yourself stand out from the crowd, but also we're really trying to give you more tools for your toolbox. So in this scenario where you're trying to retrace and break even at a little bit faster pace, options are the ideal tool for that. Again, just trying to lay out for you guys some of the simple ways you can utilize options in your long equity portfolios to make your clients happy, make your phone ring, at least with angry calls, a little bit less often. We also hit on another great strategy. Unfortunately, Mike Cavanaugh couldn't make it on the show today because this is kind of his bread and butter over there at RCM and at KYO. He likes to jokingly refer to it as the Wheel of Fun. It's also known as just the basic wheel trade. I think Wheel of Fun, a lot more fun. So we're going to go with that for this show. But this is another great way that you could utilize options in lieu of working some equity limit orders and to get a little extra bang from your long equity positions. So Wheel of Fun is really a combination of two separate strategies. We talked in the past last year on this show about using short puts, cash secured or naked, as a way to replace working limit buy orders in a stock. You write a put at a strike where you're happy to buy the stock. You collect that premium. If the underlying rallies, you got paid to work a limit order. No harm, no foul. Everyone's happy. If the underlying drops, you buy the stock at a price at a discount to where it was trading when you sold that put, and at a price you're willing to buy the stock at. It's pretty much a win-win in most scenarios. So that's a very attractive way to get into an equity position. So let's start with that. That's the first part of the wheel. And that is identifying underlying you like, then writing that put at it. Now you're collecting that income. And you may never get to the second part, or at least not for a long time. You may be writing puts aggressively for quite a while until the underlying finally retraces. You may be able to do that for many months and collect a substantial amount of income just doing that alone. And now you've written puts. I mean, you don't want to go crazy with it. That can become a recipe for disaster if you get a little bit too overzealous with the put writing. But if you do it in a cash secured, reasonable, risk defined fashion, it's a very, very useful strategy for entering a long equity position. Now, let's say you write a put, XYZ is trading 100 again. You write the 90 put. You keep writing it every month. XYZ sits at 100 for 5 months. You collect all that premium on that put for 5 months. The 6th month, XYZ drops to 89. Now your 90 put is assigned, and you're long XYZ from 90, give or take some of the premium you collected on that put. But you've been collecting premium all this time, so you're really net long from a lot lower. Who knows, maybe even 85 in this example. So you're still probably doing all right. Now you have a long equity position. What do you do with it? Well, you could sit there with it, like a lot of long equity managers do, and hope it rallies. If you don't want it, you could sell it, but of course that's kind of not why you got into the strategy. You wanted to get into this position. So now you have a long equity position, and now you can turn around and generate income on it with a covered call. And this is kind of the other portion of the wheel trade. You're making income to get into the trade, and now you're generating income to get out of the trade as well. You're getting income coming in and income going out. And how you write that covered call is really, really up to you and what you want to do with the stock. If you really don't want to hold on to the stock position very long, you don't think it's going to really aggressively rally in the near term, you may want to write an in-the-money call now, and now you're just generating more income on that underlying. And then you're probably going to be called away relatively soon, and the stock's going to be called away. So now you got paid to get into the stock position, you got paid to get out of it, and hopefully the stock didn't retrace too much in the period that you held it, and you actually generated a significant amount of income. Or you can write some out-of-the-money calls and keep doing that month after month and hope the underlying rallies to the point where you're writing that strike. If you think there's a lot of appreciation built into this underlying, then you probably want to take that approach as in lieu of writing the in-the-money calls. Really, whatever your outlook on the underlying is how you want to structure this trade. So your wheel is really kind of a two-legged approach. You come in, you wheel to get into the underlying, make income, turn around, write the covered call, and you get income to get out of it. So very, very easily replicable, easily executed type strategy that a lot of advisors out there can be doing, and quite frankly, should be doing. I mean, if you're listening to this show and you're still working limit buy orders in stocks, then you're doing something wrong. You really should be taking these very, very simple approaches and utilizing them in wherever you can in your clients' portfolios. Now, Randy, are you guys big fans of the wheel trade out there in scenic and sunny Durango?
Well, personally, I've used these strategies, for several decades. But in our basic strategy, we don't do those types of strategies. But I love the concept. Going back to your earlier point about having markets at all-time highs and potentially want to take some of the risk off the table, I like the concept of, quite frankly, selling the portfolio and just selling puts out of the money and waiting for some type of normal retracement to get back in the market. I think that's a great strategy. But yeah, generally speaking, these are all very strategies as long as you're disciplined and have an approach that's very long-term and thinking about all the different outcomes and how to play the strategy based on various market conditions.
Now, Eric, this one's a little bit more obtuse because it's a multi-leg strategy, multifaceted strategy, as opposed to just a single leg type strategies. Do you ever encounter advisors that utilize this approach? They may call it by something else. They may think they discovered it themselves. But is this a kind of a common approach you're seeing with some advisors out there?
Good stuff. You're right, though. And I would echo Randy's sentiments as well. I mean, in a marketplace right now, I mean, obviously, doing buy rates, et cetera, and sort of watching this market, hit new highs, there are a lot of positions out there that clients would like to maybe get back in, or it's sort of potentially adding to a position, and I think this Kavanaugh-esque mentality of writing puts, whether they're CSPs or again, if your firm allows you to go naked, I think in the concept of what is the ultimate goal for you and the client, is it building a position and starting to to diversify maybe out of a certain sector, or you're sitting and looking at an account where you have a position where it makes sense that things are changing in that industry, and so why not sell puts against a competitor? And I could think about whether it's the home building companies that are out there right now, and obviously we've seen in the paper that housing starts have been at all-time highs. So maybe you're sitting at one of those mega stores, and you've had a big position in there, but you start selling puts on the other company to try to diversify out of it. And so I think there are so many different tactics that are out there. And then again, as you said, Mark, once this gets assigned, then maybe what you do is you start, selling in the monies, and you're okay with being taken out. But there's just for the idea of where we are in this marketplace, I most certainly think that not enough advisors are looking at the idea of recommending selling puts here.
And I know we covered so many topics on the show this year. I really would love to hit on all of them, but I know a lot of you guys wrote in with questions too, so I want to save some time for you guys to make your voices heard here on the show. So I think we're going to wrap up the year in review with kind of that focus on options in conjunction with, or indeed in lieu of, stock in your portfolios. If you want to learn more about any of those strategies, of course, I encourage you to visit theoptionsinsider.com. We have, of course, write-ups on all that. Of course, we also have the archives of this show. So if you want to really spend some time breaking down each one of those strategies in a little bit more detail, we have archived episodes of the Advisor's Option that details each one of those strategies in a lot more detail. So you can check those out. Of course, iTunes, Stitcher, you can find those everywhere finer podcasts are purveyed. Of course, you can head on over to optionseducation.org, click on the Advisor tab there, do a little login, mumbo jumbo, and then bam, you have access to all of the great education that the guys over at the OIC have ready for you guys as well. But now it's time for us here on the show to keep on rolling and give you guys your chance to sound off, because it's time for our listener mail segment.
Listener mail. Listeners write in. Mailbox.
All right, everybody. Welcome to our final listener mail segment here for 2013. We love that you guys write in so many great questions, so we want to make sure you guys get your time here on the show as well, because really at the end of the day, it's all about you guys. If you guys aren't tuning in and writing in, then what are we doing this for? So we're going to kick things off with a question comes in here from Charles A., and wants to keep the last name secret. Very secretive fellow. But he actually writes in with a question that we've heard a lot from various advisors and asset managers over the years. It kind of reflects a somewhat basic misconception of options and why you may want to use them. He writes, I've heard it said that you should never exercise an option early. Is that accurate? Are there no scenarios when it would be appropriate? What is the point of paying for a right that you never intend to utilize? Charles, it's a great question. Like I said, we hear this a lot in various different forms and incarnations. Because you're right, people come to options and they think, I'm paying for this right to buy this stock. I'm going to use it. That's what options are for. I'm buying this call that's out of the money and the underlying has rallied. It's in the money now. I'm going to exercise. I'm going to get that call. I'm going to get my stock at a discounted price and take my money. And that's kind of a very common refrain. Put, same thing. Stocks dropped. I'm going to exercise that put. It's a very, very common mindset for people who are coming to options for the first time. But the truth is, you're right, Charles. What you heard is correct. There are a handful, but not many. There are only really a handful of scenarios where it's remotely appropriate to exercise an option early. Randy, you want to walk our listeners through some of those scenarios where they may find it beneficial to actually exercise an option, and maybe on the flip side of the coin, why they don't ever in other scenarios want to exercise early?
Well, I would say the first reason why you wouldn't want to exercise the option is that hopefully there's some time value in the option. So you're always better off to sell. I would say under most scenarios, you're better off selling the option, capturing the remaining time value of that option. And so net, you're making out more than doing it. So when would a time that you would not want to do that? I guess if the option was trading at some type of discount to intrinsic value, or if you just wanted to get rid of the underlying position, I guess that would be the main thing I would think of.
Yeah, I would add to that, in a scenario where, we're talking about dividend here, and, if we suppose that there's a dividend and, I don't know, you expect, the stock to decline by this amount, there might be an incentive there to exercise that, to avoid, I guess, missing out on that higher dividend loss, and subsequently the decline in the stock price.
Randy and Eric have both hit the nail right on the head. The reason, Charles, that you don't really ever, except for a couple of scenarios, ever want to exercise your options early is exactly what Randy expressed. Remember, we talked on the show in the past about intrinsic and extrinsic value of options. Intrinsic is kind of the meat on the bones. It's, XYZ rallies. You buy a 95 call, XYZ is trading at 100. That 95 call is not going to be trading for $5. It's going to be trading for $5 and let's say 50 cents because there's intrinsic value of $5, and then the extrinsic, the meat, the fluff, the other stuff that gets added on. Time premium, volatility premium, interest, all that kind of stuff, cost of carry, all gets packed on to the cost of the option. That's all going to be going there. That's what decays every day as you get toward expiration. So if you have an option with any time to expiration left, you're probably going to have a little bit of time value on it. Could only be a few cents, could be a substantial portion. If you're exercising that option, you're just getting the intrinsic value of that option. So in that case of XYZ, you exercise that 95 call, stock's trading at 100. You're just getting that $5. You are losing all of that extra time value that's on the value of that option. That could be 50 cents, which could add up if you have a lot of contracts. So you're always, pretty much always, much better off selling that option and collecting the full value of that option rather than exercising it and surrendering some of that extrinsic value, which could actually add up quite a bit over time. Maybe on expiration Friday, it maybe only a couple of cents and you don't want to worry about it. Still, I think it's always better selling. It's also easier to sell. You don't have to go through an exercise process and fill out forms with your brokers and indicate your intent or anything like that if you want to exercise early. Kind of a pain. Easier and much more profitable to sell the options. And Eric's right, too. The only time you ever really want to consider exercising an option early typically is with calls. And it's when you see a dividend in the underlying. So let's remember, if you're a call owner or an option owner of any way, shape, or form, you don't get dividends. Dividends are only for the underlying owners. So you're not a stock owner. So if you have let's say XYZ is trading for 100, you have that 100 call again. and you're looking at it and you're saying, well, I don't know if I want to really exercise this. I have some time value. Let's say, by the way, the best way to see what the time value of that call is, or any option you have, is to look at the option on the other side of that strike. So in the case of the call, look at the put. The put is out of the money. It's completely time value in that sense. And so so that's a good way to look at it and say, if the value of that put is, that's what my time value is. That's what you're losing by exercising that option early. You could collect that by selling that option. Now, the flip side of that is, if you're going to collect a dividend, a quick rule of thumb to say, is it really worth collecting the dividend for this option, is to say, wait a minute, is the value of the put on this strike worth, let's say XYZ is trading 100, you have the 100 call, and you're looking at the put on that strike. The XYZ 100 put is trading, let's say, 50 cents, because there isn't that much time left to expiration. Then you look at, you see XYZ declares a special dividend for the underlying holders of $1. So if you were to exercise that stock right now and switch from a call position to a stock position at 100, you are losing the 50 cents of extra premium value that is on that strike by exercising that option. But again, you're gaining $1 in dividend. So the dividend is worth more than the value of the put on that strike. It's a quick rule of thumb to have to see whether you should ever really exercise your options early. And that really is pretty much the only scenario that the vast majority of our listeners are going to encounter, that they would ever even want to consider exercising an option early. That is to capture a dividend in the underlying. Otherwise, 99.9% of the time, you're going to want to sell that option first. It's a much better, much more profitable, and quite frankly, a lot easier way to go than trying to exercise the option early. All right, next up, we have a question from Mr. Underhill. And he writes, in your opinion, what is the sweet spot between paying too much time premium for a position versus paying too much time decay for a position? And if I'm reading this question right, and I think I am, I think he's kind of asking that eternal question, Eric, of how far out do I really want to buy my options? I want to get exposure to an underlying. Let's say I'm bullish in XYZ. I want to put on a call to get some exposure. But I know if I buy a 2-year out option, it's going to be ridiculously expensive. A lot of time premium built into that. If I buy a 1-month option or even a weekly option, it's pretty much nothing but time decay. It's going to decay to zero. I have to do it all again next month, and I'm going to end up paying a lot more in decay than I'm paying if I buy a longer term option. So, but that sweet spot is kind of hard to define. And I know you guys over at the OIC, Eric, did some pretty cool studies when it came to collars a couple of years ago, and you've made some interesting findings on, for you guys, what that sweet spot was in terms of buying the long put component. So walk our listeners through some of the findings that you guys have determined at OIC when you're doing this research about where that sweet spot kind of actually lies.
Yeah, I appreciate that, Mark. And, and there's no sweet spot. I mean, I guess the premium sort of reflects, this implied vol. But I'd also, just to the last caller, Charles, and the recent caller who came in with this question, this is sort of a selfless commercial for the OIC, but it's more important for my investor services line, because when you talked about the dividend implications on that call trade, and then also just, the questions you have from your listeners, just to let people know that there is an 888 options line out there. So if you ever see something that doesn't look right, please be aware of that number, because those specialists are there to decipher anything that might look a little bit unusual. But relative to your caller's question about this, I mean, you could say that there are considerations. I guess it should be given I guess when implied vol is high, compared to historical vol in that underlying, you might get the direction right on the underlying, buy-in, but losing money, sort of due to this reduced vol. It's our study, Mark, which you're referring to, which we did on the collar, is actually we're giving a little bit of a sneak preview to your listeners here into 2014. We're actually going to be doing a covered combo into the first quarter of next year, which we're excited about, because it's going to be a strategy I think a lot of advisors will embrace upon. But this will also be a first time for the OIC really to be able to look at specific names.
Now, Randy, you obviously deal with this issue quite a bit. You guys are constructing overlays all the time on broad indices and other things like that. So you're always kind of dealing with that trade-off between time premium of buying a near-term put versus outlaying a ton for a long-term put that you may have to roll down the road. So where do you tend to find that sweet spot? Where do you draw that line when you're constructing your overlays?
Well, I think the overlying principle is, when do you expect something to happen? For example, let's say that you thought some news event was going to come out over the next 3 or 4 weeks. If that was going to be true, then I would buy an option that went past that date, but wasn't paying for something 6 months, a year down the road when it wasn't really part of the trade. So I think that's one component where I would choose a shorter term option if it's event driven and something's going to happen relatively in the near future. At Swan, we're more long term focused, and we're not into trying to pick a certain event or timing the market. We want upside exposure or equity exposure to the market. And so we typically when we buy options, we're buying longer term options, hoping that the rate of decay in that interim time is lower than constantly rolling from, let's say, 3-month options to protect our portfolio. So like I said, it just depends on your time horizons. Really the critical component to be able to answer that question. And I think that there's scenarios for every type of option, every type of duration. It just depends on what your goals and objectives are.
Well said, Randy. And Eric, like I said, I'm glad you guys are on this show as well, because to my knowledge, OIC is really the only people who've conducted any kind of lengthy studies that kind of touch on this exact issue. And it goes back to that collar study and how you determined whether to buy, of course, collar, long put, short covered call, where to put that long put component. If you buy the front month, you're paying a lot of decay. If you buy a year or 2 years, you're paying a lot of extra time premium for not really much added value. And I think the sweet spot you guys came down to was about 6 months. That was for that collar scenario, buy a 6-month put, write a front month call. It seemed like an interesting finding. I encourage all of our listeners to surf on over to optionseducation.org, read that study for yourself. We also have links on the Options Insider if you want to find it there. I think it was called Collaring the Qs or Tightening Your Collar, both of those revisions on that. Interesting stuff if you want to see some actual data on how that works out from a time premium versus decay type of perspective, which actually is exactly your question, Mr. Underhill. So hopefully we addressed it in some way, shape, or form. 6 months seems to be the kind of consensus sweet spot, but like Randy said, it really depends on what exactly you're up to and what your time horizon and what your outlook is on the underlying. Last up here, we have a question from Tom G. Goes by I think Metog here on Twitter handle. He writes, at Options, my advisor uses levered short SPY ETFs to hedge my portfolio. Your thoughts versus using puts? I think we touched on this before on the show. In general, kind of, these levered ETFs have kind of cropped up in the past couple of years, and a lot of advisors have jumped on these things. And I kind of jokingly, really only half jokingly, refer to these as kind of the poor man's options. They are a way for the advisors to kind of think that they're doing some of the same things that you get from buying a put, hedging, they're giving you downside protection, all these kind of things. But in reality, it often doesn't work out that way. Usually, at best, it's some sort of near approximation to what you could do yourself, you constructing a put or a hedge yourself, or your advisor doing it on behalf of you with your clients. So maybe I'm preaching from the choir here, so maybe my view is a little bit jaded on this, but I've always tended to view it, if you're interested in this, if you're interested in actual hedging, and let's say in this scenario, hedging a long S&P portfolio, you're pretty much always going to be best off using a direct type hedge like a put or a put spread. You construct it yourself. You can set the exact parameters that you want, or you should sit down with your advisor and discuss the parameters that you want, and the two of you can help construct that hedge. Because at the end of the day, these levered ETFs, they can have a whole, I don't know which ones particularly he's using. That's one of the problems. There's a myriad of these things. They're all constructed in different ways. They all perform differently depending on how they're constructed. A lot of these things reset every day. So if you're getting aggressive moves and things like that over long periods of time, you're going to underperform with that daily reset versus buying the hedge outright. It's just, if you're buying a levered thing as a spec, that's a different story. Still, you could do better using options outright versus using these levered ETFs. So I'm pretty much always going to come down on the side of the fence of, if you want the type of thing that levered ETF is giving you to, it could be levered upside, could be levered downside, could be whatever the case may be. You're pretty much always better off using it with options. But the problem is a lot of advisors don't want to go through the effort of learning how to use options. So they find these simple products that they can slap in your portfolio, charge you a fee maybe, and everyone's happy. So at the end of the day, I would encourage you, Tom, that's what your advisor insists on doing. Maybe you consider looking for another advisor, someone who listens to a show like this and can understand all the things we've talked about in terms of the wheel and stock replacement, stock repair, and indeed hedging, because these are things you want an advisor to be able to do on your behalf. Eric, what's your take on these levered ETFs? I know when you go around the country, I'm sure that's probably a lot of the pushback you get from advisors. Why do I need these option things? I have my levered short SPY or whatever the heck it is that they're trading.
Yeah, it's interesting, Mark. We talked about structured products, I think, during the summer here in your program, which was a great episode. And, I try not to deter, being from an agnostic vantage point, that, our whole mission is, as your listeners know, is to bring retail clients, institutional clients, and advisors into our congregation, which is open to anybody, and to learn the value. And so I think that I try not to deter anything, but you're absolutely right. There has to be caution, Mark. I'm sure Randy would agree. I know Mr. Cabby does as well. These levered things, on the surface might look sexy and might be appropriate as you're doing an allocation, but you really got to lift the hood on this. And, I think that, the most important thing for your listener sent this in here is, what's the composition of this guy's portfolio and what is he trying to hedge? And, is it a one-to-one? How unique is his portfolio? How is it weighted? But, these levered ETFs, I think there needs to be a better understanding from the client and the advisor.
Randy, you take as dim a view of these levered ETFs as I do, or are you more in the agnostic camp like Eric?
No, I actually agree with you. I just look at it from it's very hard to quantify the risk of these based on, like what you said, how often do they reset? Do you really know exactly how it's going to really work out over time? I just think the options are just a much better way to hedge the downside risk. And for another reason, at some point, if you're just trying to reduce your exposure, maybe you're better off just selling the underlying. I mean, if you're just trying to go on a holding period and say, I want to kind of have an offsetting position, if you're not really confident that offsetting position is really going to work as you intended, it makes it problematic. You may not get the result that you want or you expected.
There you go. 2-1, Eric, so we win. Levered ETFs are garbage. Just kidding.
Well said, guys. Actually, well said, Randy.
All right, and we're going to wrap it up here with one final email. This is from Joe Bagadonuts, who may sound suspiciously like one Eric Kotz, but I'll leave it to the listener to decide who actually wrote this email. He writes, "Hey, Longo, is that Italian? Because I got a cousin, Vinny Longo, from Bensonhurst. This is Joe Bagadonuts from Boca Raton. I go naked short on puts sitting here in my New York Jet boxers, and I have made a ton of moolah on them GOOG thingies. What do you guys think of them mini doodads? Are those minis things like the little cannolis I get at Publix Market here on Southwest 18th Street? I love those little things. My wife won't let me eat the big Italian Arthur Avenue Dolce anymore, so thank the Lord for the minis." All right, and Eric, I think this is your long-winded way to insert the minis into this conversation. And you're right, the minis were kind of the big heralded announcement. They launched earlier this year, back in March, after a kind of a lot of fanfare, a lot of drumming, a lot of support, a lot of people thinking this was going to be the panacea. This is going to solve a lot of the issues of the options market, particularly when it comes to retail, and a lot of the advisors in this audience who they have a lot of, let's say, fractional positions in Apple and other things that can't afford to buy round lots, so the options really aren't that useful for them because a one lot is for 100 shares. So having minis that were 1/10 the size seemed to solve a lot of those problems. If you had 70 shares of Apple, now you can do 7 minis instead of trying to use one full-size contract and having a lot of extra, deltas and things. So you're right. It seemed like on the surface that it was a really, really attractive thing. And unfortunately, it doesn't seem like that's really unfolded that way. I mean, when you talk to the advisors, Eric, do you get any feedback or interest in the minis? Are they even aware that these products exist?
They aren't, and I promised myself I wasn't going to get emotional and start crying on this being the last call of the year.
But that Joe Bagadonuts, he's an emotional guy. He can bring it out of you.
He's an emotional guy. But I do want to say, in terms of the minis and what we're hearing from the advisor community, absolutely, Mark. They're still not aware of it, which is one of the reasons we're out there talking about it to a lot of firms. But, as we know on this call, it's an historic year for us in the industry. Obviously, look, the first listed option traded the end of April 1973, 40 years ago. We now have 12 exchanges. The OCC is celebrating a 40th year, 21 years for OIC, and we have new exchanges. We have flex options. We've got longer dated, leaps. We now have mini. I think the whole concept for the advisor community is that we continue to evolve on behalf of our clientele. And so, I give a great shout out to Randy and the team out there in Durango. They've done an incredible job. Mark, you have as well, raising the bar in terms of awareness. And as you said, continually on this episode and this call, if you're ignoring this concept and you're ignoring options as a whole, it's a foolish thing, because you are able to implement something in any market scenario that can bring a solution and solve a problem for a client. So, I'm passionate about what's going to happen into next year. I think that we will actually see more listings for minis and, hopefully some other exciting things to happen as well.
Randy, the craziness of Joe Bagadonuts aside, what's your take here on the minis and what you've seen from them so far in the marketplace?
Well, I like the fact, generally speaking, you want options literally. So the fact that there's more products, better products, more versatile products, I think that's positive for the investment community at large. And so we all are heavily involved in the options market at different types of in different ways, but more is better.
I guess I'll get the final word here on minis then. And you're right, I agree, more is better. They are very interesting products. I think there have been some issues with the way they've been implemented. So I think, unfortunately, I'm still going to kind of maybe recommend to a lot of our listeners they perhaps hold off unless they have a very, very specific use case for minis on behalf of their clients, because the problems we've seen with minis is that there aren't still many liquidity providers in them, not a lot of market makers, so the spreads are still too wide. The spreads are wider than the large options themselves. So getting into minis, you're going to pay a significant premium. Getting in and out, going to be a lot of slippage there, which you're going to have to, it's going to be costly. So you have to really want to get into a mini right now to really do it. The size isn't there, of course, because they're not very liquid. And, of course, there's issues with the commissions on these things. Like, for example, if you do 5 minis and 1 big contract or something like that, you want to do like a net 15 kind of minis, the firms are going to charge you multiple ticket charges for each one of those trades. The commissions are still the same price, even though it's a 1/10 size contract. There's a lot of issues with pricing and execution around these minis that still have yet to be resolved 9 months after they launch. So I'd probably encourage our listeners, play the waiting game a little bit. Let the industry kind of sort these issues out. Maybe we'll see them listed on more names, and they'll become a little bit more liquid, a little bit more popular, and then it'll be a little bit easier for you guys to dive in, because theoretically they're great. Theoretically they solve a big problem. Practically, what's been implemented so far, not really there yet, but hopefully they'll get there in very, very soon. So Joe Bagadonuts aside, the rest of you guys really wrote in with some great questions. And of course, with this final show here at 2013, I want to take a moment really just to thank all of you guys out there in the listening audience. You guys have been fantastic. You guys, your support has been the reason why we do this show, the great questions you write in with, the way you guys download this show on an aggressive basis. We really love to see that. We really love to see that more advisors are coming into the options fold. That's really the reason we're doing this show, is that for whatever reason, options still haven't penetrated into the majority of financial advisors out there, and they really would be very suitable for the vast majority of you out there trading long equities on behalf of your clients. So we're really, really appreciative you guys have embraced the show the way you have. And hey, tell your friends, tell your neighbors, tell your colleagues that there is something out there to help explain options for the advisors, because quite frankly, they could use it. Or hey, maybe keep it to yourself. It's your secret weapon to make you stand out amongst all of the other advisors out there. And before we sign off for the year, Eric, why don't you go ahead and give our listeners a little bit of a sneak preview of what's coming up over there at the OIC for advisors in 2014?
Absolutely, Mark. Thank you. As I said previously, we're excited about a study that we're going to do with Purdue on the covered combo. We also are going to be releasing the second iteration of the quantitative study that was done on advisors back in 2011. So I'm very excited about that. This is going to be a part 2 of an in-depth study on advisors and how they're using options. And lastly, we're gearing up for our trek to the music capital, Austin, Texas, sometime in May. which will be the institutional conference with a participation by financial advisors, for our options industry conference.
And Randy, you have some big news just kind of launching today as we're recording this, but probably even bigger plans for 2014. So why don't you let our listeners in on what the latest happenings are and what's coming up over there at Swan Wealth Advisors?
Sure. We're happy to announce that today should be the official startup of Swan Reinsurance. It's a Bermuda-based reinsurance company that it's a manager-sponsored reinsurance company that Swan's going to be involved in, and so it's kind of a twist on our basic defined risk strategy that we've been running since 1997. We're going to take that exact same strategy, put it inside a reinsurance company, and allow to use the premium float, the collect premiums now, pay out claims later, to be able to invest in the defined risk strategy. And there's a lot of potential benefits for investors. So if anyone's interested in that, go to our website. We think we'll do our first bit of underwriting before the end of the year. And we expect to have an IPO sometime next year, probably in the summer. That's at least our goal at this point.
All right, and listeners, if you want to learn more about that, be sure to check out SwanWealthAdvisors.com for more information on everything Randy and the team over there at Swan have cooking. And, of course, we're very happy here at the Options Insider Radio Network to have Swan and OIC on board this fine program, and we're looking forward to many more exciting episodes of the Advisor's Option to come in 2014.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.